What's up, everybody? It's Professor Reiko here, continuing on our chapter on the accounting for income taxes. So the video we just looked at changes in tax rates after we'd already recorded our deferred tax asset or liability. This one's going to look at changes in tax rates while we're creating our deferred tax asset or liability, meaning we have a temporary difference this year. We know that's going to reverse out over the next few years. And we know that those rates are going to change, okay? So if that's the case, if those rates have been enacted just means enacted into law, we're going to measure the deferred tax asset or liability using the enacted tax rate for the future years when the difference is expected to reverse. All right, so let's think about that. When we calculate the deferred tax asset or liability, we take the temporary difference and we multiply it times the tax rate. Well, we're going to be doing the same thing. We're going to be taking the difference by the tax rate, but now we're just going to do the difference by the times the tax rate by year. So it's just one extra step, but theoretically we're doing the same thing. Okay, so it shouldn't be too hard. It's just one little extra step that we're going to add in. So let's walk through this example. We got a company. They have financial income of $35,000. They have unearned rent revenue of $55,000. Okay, now read here. It has been recognized as taxable income because remember the cash has been received, but we have not recognized it in our financial statements yet. Okay, so let's think about it. The journal entry is cash and credit unearned rent revenue for $55,000. All right, so that would be the journal entry when we have the unearned revenue. All right, so that cash, because the cash is received, we'll recognize it as taxable income. However, that is not revenue in our financial statements yet, so we have this difference here. Okay, so if you think about a few videos ago, I wrote out the shortcut for tax. If you look at taxable amounts minus deductions, gives you taxable income. All right, and so this one falls into the example of we are going to have more taxable amounts because this $55,000 is all taxable because it's going to be on our tax return as income. Therefore, but it's not on our financial statement. So we're going to have more taxable amounts on our tax return. Therefore, our taxable income is going to be higher. Now, remember, this shortcut is important, so make sure you go back and watch those previous videos where I did that because that tells me what I'm going to do in the reconciliation. All right, and we'll see that in just a second. All right, so the unearned rent is expected to be recognized in the following pattern. All right, so we can see here's the $55,000, and this is how it reverses out over the 4 years. And now here we have the enacted tax rate for this year and the next 4 years are as follows. So this is a little extreme. The rate's jumping all over the place, but it kind of just helps illustrate the example. All right, so in prior examples, we would have taken this $55,000 difference and multiplied it times the current year's tax rate because that's the only tax rate we knew. All right, now what we're going to do, since we know all these future tax rates, is match up each difference with its, we're still going to multiply the difference times the tax rate. We're just going to do it by year, meaning up here, I'm going to do the tax rate for 2007. For 2008, it would be the tax rate for 2008, which is 30%. 2009 is 30%. And 2010 is 37%. All right, so I'll just multiply those across real quick. We get 5,100, 6,000, 7,600. I'm sorry, that's 3,600. 3 times 12. Sorry, I was reading that wrong. And that's 2,960. All right, so add that up, we get 17,660. So that's going to be my deferred tax asset. Now remember, it's a deferred tax asset because, well, we'll see that in the reconciliation. I'd be jumping ahead of myself a little bit there. But remember, up here when we did the shortcut, anything that was a plus in the reconciliation is a deferred tax asset, and everything that's a minus is a deferred tax liability. So that's a good little shortcut to make sure you remember. All right, so it says prepare the journal entry. Well, the first thing we need to do is come up with taxable income, which is our reconciliation. All right, so remember our reconciliation, we always start with financial income, which was $35,000. We have one difference, the unearned rent revenue. Remember, the difference is $55,000. All right, so the key thing is, do we add it or subtract it? Well, I already said up above that we are going to add it, okay, because we have more. Think about it. All of this unearned rent revenue, if we go back and look at this journal entry right here, all this cash is recognized as revenue on our tax return, but not revenue on our financial statements, which means it is the $55,000 is not included in that number, but it needs to be included in taxable income. Therefore, we need to add it to put it in to taxable income. So that puts us at, and then multiply it times the current year tax rate, and that's going to put us at 30,600. I apologize, my dogs are barking in the background. All right, but once again, taxable income is greater than financial income, so that means we are paying more now, which means we'll pay less in the future. So it's a deferred tax asset. We already said it was a deferred tax asset, but that's another way to kind of reason through that. All right, to do our journal entry real quick, we have income tax expense, which will be our plug number. We have a deferred tax asset and income tax payable. And the income tax payable we said was 30,600. We calculated this up here, and it was 17,660. And then this will be our plug number, 12,940. So in prior videos, I said you can't take the financial income times the tax rate to get this number. And that's in this example, you see that you can't do that because the changes in tax rates would mess up that number. Okay, so always view this income tax expense as we defined it in the very first video as the net of the current taxes and deferred taxes. And that's exactly what we do in this journal entry. All right, so this is just one extra step in addition to stuff we've already been doing. It just looks at it when we know the changes in tax rates. All right, so make sure you kind of walk through this and have a good grasp on this. This is an easy problem to ask on a test. Something like this with changes in tax rates, adding in one or two temporary differences and maybe throwing like a permanent difference in there as well, that kind of make that the big problem that you have to work out in the test. So make sure you kind of have a good grasp of this and understand it. Go back and watch that prior video. It was the third or fourth video with the shortcuts on that will help you with the reconciliation. Okay, so I hope you're enjoying it. Please, share these with your friends. Please subscribe to the channel. It does help me out. And I hope you tune in next time. Thanks.